Today we're gonna discuss the real cause for the banking crisis. Everybody is distracted. They're paying attention to the Fed's balance sheet. They're paying attention to interest rates, but very few people are actually looking at the bigger picture. And make no mistake, what I'm about to talk about today, the Fed knew since day one. So much so that every Fed official sold all their stocks at the very peak of the market, back in September 2021, right before unleashing the most aggressive liquidity experiment of the last century. And this is exactly what this crisis is about, liquidity, which is a fancy word for money in circulation. A bank run is, in its most fundamental form, an extraction of liquidity from the banking institution, to the point where the bank becomes insolvent because it runs out of money. Think about Silicon Valley Bank or even FTX. They fail when everybody rushed to withdraw their funds all at once, leaving them dry. In fact, the order in which institutions have failed so far is directly correlated to the risk profile of their balance sheet items. Because the higher the risk of the asset, the higher its sensitivity is to liquidity changes. Crypto fell first with 3 Arrow Capital, Terra Luna, and FTX. Then it was crypto banks like Signature. Then Silicon Valley Bank because VC money and tech startups is next in the risk profile scale. Then finally mainstream banks such as Credit Suisse. They all had similar liquidity problems, just in different order. So if liquidity is the problem, then what causes high or low liquidity in the system? That's where the Fed comes in. The Fed is the only entity that can inject money into a system or suck money out of the system. They have historically done this by lending out to other banks at a certain interest rate. This is what is called the federal funds rate, and the amount of money the Fed has lent out is the Fed's balance sheet. So for many decades, investors have looked at the Fed's balance sheet to measure liquidity in the system. But the Fed changed the game in 2020. They wanted to remove liquidity in the market, but in a more secret way, one that would give Federal Reserve officials a chance to unload their positions. So instead of reducing the balance sheet, they issued fewer short-dated T-bills. This created a shortage and low-duration paper that financial institutions needed to be able to provide liquidity into the economy. At the very same time, the Fed raised the award rate on the reverse repo, which is the next best low-duration risk alternative. The result? Over $2 trillion of liquidity got sucked into the reverse repo and became unavailable to circulate in the economy. But what does this mean? Why do we even care? Well, meanwhile the Fed was setting up the new repo system, the banks and crypto institutions were getting record deposits, and they were buying bonds like there was no tomorrow. And this would make sense because the Fed was doing the same thing. Plus the balance sheet kept increasing, hence no sign of tighter conditions. Then the Fed sucked $2 trillion into the reverse repo overnight and hiked interest rates from 0 to 5% on the new balance sheet loans. This crushed the value of bonds, which the banks had bought. And with so much liquidity in the reverse repo market, if there is need for cash, you're kind of screwed, because no other bank will lend you money. Their money is already parked in the reverse repo. With banks failing left and right, and even Deutsche Bank in stress, the Fed has finally decided to open a lending facility to backstop this crisis. So people are very excited about this because technically speaking, it's a liquidity injection. But if this money ends up being sucked into a reverse repo again, we're in the same situation. You gotta remember, the reverse repo offers a better yield than the federal funds rate and has no risk of asset fluctuation. So it's a very compelling instrument for banks to use. But I have a feeling that Fed officials, including Jerome Powell, won't lower award rates on the reverse repo until they and their friends buy back into a market. Because if you control liquidity, the game becomes very easy to play. Now, if you enjoyed this video, you probably will enjoy this one about why interest rates won't affect Tesla anymore. So thank you very much for watching, and I'll see you next time.